Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
As of market open this morning, February 18th, 2026, we are looking right at the tape for Rivian Automobile, ticker RIVN. It is currently trading hands at, let's see, $16.54. That is up just about 1/3% from the previous close, holding a market capitalization of roughly $18.97 billion. But do not let that flat percentage mislead you. The volume today is incredibly heavy. The 30-day average sits at nearly 33 million shares. So this stock is clearly consolidating, but it's still vibrating from that massive 26.6% single session surge we saw just back on February 13th.
Which was, just for the record, the largest daily gain since the IPO back in 2021. The market definitely woke up.
Yeah, it certainly did. And right now, technically speaking, it is testing a really critical level. We are sitting right on the Fibonacci 50% retracement at $16.52. This is the pivot point. It is the line in the sand between its 52-week low of $10.13 and the high of $22.69. The market is trying to decide essentially right at this minute if this is a distressed automaker bouncing off the absolute bottom or if Rivian has fundamentally transformed into something else entirely.
And that is the central question, isn't it? Because the catalyst here is obviously that Q4 2025 earnings report. The bulls are out there calling it a decoupling from the struggling broader EV sector. They see a tech platform emerging. But look, I look at the exact same balance sheet and I see a company trading at over 4 times sales while its core automotive revenue is actually shrinking.
I see why you might think that, but let me give you a slightly different perspective on what that report actually signifies. We really need to frame this debate correctly. Has Rivian successfully metamorphosized from a speculative hardware manufacturer into a high-margin technology platform? Which, by the way, would justify a $44 intrinsic value? Or is the current 4.08 times price-to-sales multiple just a premium valuation on a company with declining auto revenue and massive execution risks still ahead?
A premium that, to me, looks increasingly like a massive valuation trap.
Well, I'm going to argue that the structural shift to software margins, specifically the Gen 2 zonal architecture, and obviously the Volkswagen Alliance, has fundamentally de-risked the company. It's not just a car company anymore. It is a deep value play.
And I come at it from a completely different angle. I'm sorry, but I just do not buy that the whole tech platform narrative justifies this price tag. I argue that this valuation relies entirely on the unproven execution of the upcoming R2 platform. You can talk about software margins all day, but if you strip out the one-time cash injections, the core automotive business is facing a serious demand crisis.
Let's get right into the position statements then, because I think you are missing the forest for the trees here. The market is pricing Rivian as if it is still 2024, worrying about cash burn and production hell. But just look at the fiscal year 2025 gross profit swing. This is the smoking gun. In 2024, they posted a $1.2 billion gross loss. In 2025, a $144 million profit. That is a $1.34 billion improvement in 12 months. You simply do not see that kind of swing in heavy industry without a fundamental change in the physics of the business.
I'm not disputing the number itself. I'm disputing the quality of that number.
But the quality is the best part. They didn't achieve this by just, selling more trucks. In fact, volumes were flat to slightly down. They did it because software and services revenue surged 222% to $1.56 billion. This is the core thesis. Rivian has successfully transitioned to a hybrid model. The Gen 2 zonal architecture reduced their electronic control units, the ECUs, by 60%. They stripped literal miles of wiring out of the chassis. They dropped the cost of goods sold per unit down to $92,000. So the path to profitability is no longer theoretical. It is actually proven right there in the unit economics.
That is a compelling argument. And look, the engineering is impressive. I will absolutely grant you that. But have you really considered what is hiding behind that so-called profit? You call it an investment pivot. I call it a revenue illusion. You mentioned the gross profit swing, which looks fantastic on a spreadsheet. But look closely at the automotive revenue. It declined 15% year over year to $3.83 billion.
It was a transition year. They literally had to shut down the plant to retool for the Gen 2.
It is a demand signal. They are selling fewer cars. And regarding that valuation you brought up, Rivian is trading at a price-to-sales ratio of 4.08. Let's put that in context. The industry average for auto manufacturers is 0.60. Even Lucid, which has its own massive set of problems, is trading somewhere between 1.7 and 3 times sales. You are paying a huge premium for a company where the profit is largely derived from the Volkswagen deal. In Q4 alone, 60% of that software revenue came directly from the joint venture. That is B2B licensing cash. It is not consumer demand growth. If you strip out that VW cash injection, you are left with a car company that is still burning cash and struggling to move metal.
I am just not convinced by that line of reasoning at all, because you are treating the Volkswagen alliance like it is some sort of one-off grant, like they just won the lottery. It's not. It is a structural evolution of the business model. Let's dive right into this, because this is really the first core topic of our debate. The Volkswagen Alliance, the RVA Tech joint venture, you see it as a crutch. I see it as a savior.
Savior is a very strong word for a competitor, basically buying your tech because their own software division failed.
But that is exactly the point. It validates the tech stack. If Volkswagen, the second largest automaker on the planet, decides it is cheaper and better to pay Rivian than to try and build it themselves, that tells you everything you need to know about Rivian's moat. The velocity of this partnership is unprecedented. It went from a handshake to a massive revenue driver in a matter of months. As we noted, Q4 alone brought in roughly $273 million from the JV. But look at the actual roadmap. This isn't just money changing hands. Right now, in Q1 2026, Rivian and VW engineers are conducting winter testing on actual vehicles. The VW ID.1, the Scout, various Audis, they are running Rivian zonal architecture in real-world, cold weather conditions.
Right. And if they fail?
If they succeed, which is absolutely the base case, given the dedicated engineering headcount of over 1,500 people working on this, it unlocks another $1 billion equity tranche mid-year. That prevents the exact kind of shareholder dilution that the bears are so terrified of. This isn't just cash. It is the global standardization of Rivian's operating system.
I see the potential, sure. But let's look at the dependency here. Rivian is heavily relying on Volkswagen engineers to validate their stack. You mentioned the $1 billion tranche. That cash is strictly contingent on milestones. If this winter testing hits a snag, and let's be totally honest here, software integration across fundamentally different hardware platforms is notoriously difficult. That money is entirely at risk.
Every major engineering project has risk.
Yes, but not every company has their short-term solvency directly tied to it. And let's go back to those margins. You celebrated the $576 million in gross profit from software, but automotive gross profit is still negative. They lost $432 million strictly on building and selling cars in 2025. The core business, the thing they are actually known for, the trucks on the road, is still underwater. The VW deal is masking the brutal fact that they lose money on every single vehicle they hand over to a customer.
But the trajectory is undeniably positive. They improved that automotive gross loss by 64% year over year. They are explicitly targeting a positive automotive gross margin exit rate for 2026. And that brings us perfectly to the mechanism of that change, which is the R2 platform and industrial scaling. This is where the thesis moves from software back over to hardware.
Ah, the show me portion of the story.
The scale portion of the story. Have you seriously looked at the sheer scale of the expansion in Normal, Illinois? We are talking about a facility that has grown to 9 million square feet. They dug subterranean logistics tunnels under the Rivian motorway just to connect the supplier park directly to the line. This isn't a science project anymore. They are prepped for 155,000 units of R2 capacity a year.
Capacity is one thing. Utilization is another entirely.
The R2 reveal is March 12th, just a few weeks away. The target price is $45,000. This finally opens up the mass market, the 70% of buyers that Rivian currently cannot touch with the R1 pricing. The pre-launch reservation data, the sheer hype around this vehicle, it perfectly positions them to take share directly from the Tesla Model Y.
That is a highly compelling narrative. But let's talk about execution risk. The jump from R1 to R2 is not linear. It is exponential complexity. This is the exact production hell phase that nearly bankrupted Tesla a few years ago. And look at management's own guidance. They are guiding for 62,000 to 67,000 total deliveries in 2026.
Which, mind you, is a 50% increase over 2025.
Sure, but do the math on the R2 specifically. That guidance implies the R2 will only contribute about 20,000 to 25,000 units this entire year. That is a painfully slow ramp. It suggests they are heavily anticipating bottlenecks. And context matters here. Competition is fiercer than it has ever been. The Model Y utterly dominates this segment, and high interest rates are still crushing the $45,000 buyer. You are assuming they can just walk in and take massive market share, but they are romping slowly into a highly saturated market.
I think you are severely underestimating the pent-up demand for an alternative. The market has bifurcated. There is a real flight to quality. People want an alternative to the Model Y, and they actively want the Rivian brand cachet. But let's zoom out to the actual numbers, because this ultimately comes down to what the stock is worth today. Valuation paradigms.
DCF versus market reality.
Discounted cash flow versus, frankly, short-termism. If you run a standard two-stage free cash flow to equity model, assuming they hit that positive cash flow metric by 2030, and you use a reasonable 8.4% discount rate.
2030?
Yes, 2030. The intrinsic value comes out to $44.42 per share. The stock is currently trading at $16.54. That is a 60% discount. The market is pricing RIVN like a failing car company, but the margin profile they are actively building, targeting 25% long-term margins, is that of a highly scalable tech platform. You are basically buying a dollar for 40 cents right now, because the market is just afraid of the next 2 years.
I'm sorry, but I just do not buy that timeline. Positive cash flow in 2030, that is 4 years of burn away. In this current interest rate environment, 4 years is an absolute eternity. Look at the guidance for fiscal year 2026. Adjusted EBITDA is expected to be negative $1.8 billion to $2.1 billion. CapEx is another $2 billion because they are resuming construction on the Georgia plant.
You have to spend money to grow. The Georgia plant adds 400,000 units of much-needed capacity.
$1 million next year that they simply do not have from operations. They are essentially burning the furniture to heat the house, hoping the VW money keeps the lights on long enough until the R2 maybe saves them. The market should not pay a premium today, again, 4 times sales, for cash flows that might appear in 2030. A tech multiple requires tech margins today, not in a spreadsheet model 5 years from now.
That is an interesting point, though. I would frame it very differently. The market pays for growth and position. Lucid is trading at a similar or even higher multiple with genuinely hideous unit economics and no clear path to mass volume. Rivian has the massive factory, they have the global partner, and they have the unit economics finally moving in the right direction. That $92,000 COGS number is the reality check here. They are aggressively driving costs down while the rest of the competition is racing to the bottom on price.
Driving costs down on a vehicle where revenue is dropping 15%? You cannot cut your way to growth if the top line is inherently shrinking.
The top line is shrinking on the R1 purely because they are transitioning to the R2. It is a classic Osborne effect. Customers know the new tech is coming, so they are waiting. That is exactly why the March 12th reveal is so critical.
Well, we certainly agree on that. March 12th is the defining date. But let's go ahead and wrap this up. We are looking at the exact same data and just seeing 2 completely different companies.
I see a major industrial inflection point.
And I see a textbook valuation trap. Let me just summarize the bear case here. I fully acknowledge the technological achievement. The zonal architecture is highly impressive, but the valuation is far too rich. Rivian is the ultimate show-me story right now regarding the R2 ramp. Until they literally prove they can build 150,000 units in normal without breaking the bank, and until they show me that the VW deal isn't just a temporary lifeline, paying a 4-time sales premium is gambling. It isn't investing.
And I will reiterate the bull position. The existential crisis for Rivian is effectively over. The VW deal and the massive swing to gross profit prove that the underlying business model actually works. The discrepancy between the $16 share price and the $44 intrinsic value offers a truly rare asymmetric upside for patient capital. You are worried about the next 4 quarters. I am looking at the next 4 years.
The next 4 quarters absolutely determine if they survive long enough to see the next 4 years.
That is the core tension. Both of us agree that the critical date is March 12th for the R2 reveal, and subsequent to that, the Q2 delivery numbers.
And do not forget the winter testing results. If that $1 billion tranche does not hit mid-year because of some software bug in an Audi, the thesis changes literally overnight.
High stakes, high reward. Whether Rivian truly becomes the manufacturing sovereign of the US EV market or just another high-profile cautionary tale hangs entirely in the balance of these next few months.
We will definitely be watching the tape.
That we will. That's the debate for today.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.